Welcome to the Why Not Real Estate Podcast, where you will learn top strategies from world-class real estate investors, both large and small. Why not? Tune in and get started today.
Think about knowing what type of investment you're getting in. We have no idea what's going on inside of corporate company for stocks and mutual funds. But if you think of a multifamily, what is it? Most people have rented an apartment, so they know what it's like to live in an apartment. It's income. What I love about it is pretty simple if you think about it. There's income and expenses and how much is left over, right? You're generating income for the rents, products, the real estate, you have expenses, you have a mortgage on the property that you have as expenses. And the better you run the property, the more income it generates, the more income the property produces. That's why we can sell it as a profit 4 or 5 years down the road, because along that way, we're increasing the income so we can sell it at a higher price, because multifamilies are sold based on how much income they generate, right?
Hey, what's up, all of my real estate peeps? This is Brian Lucier with the Why Not Real Estate Podcast, back with another episode where we believe investing in multifamily is one of the best asset classes in real estate. Although on numerous shows, I have been showed other tracks, and why not, right? That's why we're here, to learn about investing, opportunities, and what's out there. And boy, what a segue into a sequel we have for you today. In the 3 years of putting out the show, this is the first time we've had a guest come back for a sequel. And I'm really excited because personally, this guy, a dear friend of me, he's been my mentor and coach throughout the years. He's walked me through like a Sherpa, and we were just chatting off in the green room, and I was telling him a little bit about what we've been doing and just catching up, and really amazing. And I can't wait to get started. So let's do it. So today's guest is a rare blend of analytical expertise, business acumen, and heart-centered leadership to the world of real estate investing. He is a former mechanical engineer who holds a U.S. patent and spent nearly a decade designing innovative thermal and mechanical systems. But his true passion emerged when he pivoted into real estate, where for the past almost 2 decades now, he's coached over 1,700 investors through RE Mentor on how to acquire and finance large multifamily deals. Typically, these deals ranging from $5 to $15 million in size. So this is no small lift. Our guest has raised millions of dollars in capital, partnering with over 1,800 multifamily units. I got to say that again. He's raised millions in capital, partnered on over 1,800 multifamily units. That's huge. And he's the creator of the multifamily analysis underwriting software used by thousands of RE Mentor clients nationwide. And if all that's not enough, our guest is also the co-founder of Flag for Hope, a philanthropic project that brought him together with icons like Muhammad Ali, General Colin Powell, Sandra Day O'Connor, and over 400 U.S. veterans to create one of the most patriotic art installations in America. Today, he's here to share why he recently ramped up his personal investing again. That's absolutely going to be a story. And what led him to form a strategic capital raising partnership with Viking Capital, and how new and experienced investors alike can generate passive income through hands-off multifamily investing safely, smartly, and profitably. Ladies and gentlemen, all of my real estate rock stars, peeps, and entrepreneurs, it is my pleasure to welcome back to the show my personal coach, mentor, and friend, Mr. Don Goff. Don, welcome to the show, and it's a pleasure
Thank you.
to have you back.
Hey, thank you so much, Brian. And you're not just one of my students, you're one of my Hall of Fame students, Brian. You killed it out there. You took a lot of action, had a lot of growth. and very impressive what you accomplished over the years. And when I started seeing your podcast come out and we were talking about them, I can't believe that now you've been doing it already 3 years, and I'm honored to be part of it.
Don, honestly, the podcast wouldn't be here if I hadn't met you and you hadn't been my mentor, walked me through coaching. I mean, if I went back, I would spend hours just explaining what you explained to me to other people. So if it's okay with you,
Thank you.
I'm doing a podcast to help share the inspiration and what you've taught me to change my life. So
Oh, thanks a lot. I really appreciate that. And that's why I coach and why I continue to coach. I never thought I was going to be a coach, but it led me to that once I started coaching. I loved it. And I loved seeing how it could change people.
let's jump right in and let's get started with your story. Don, how did you get started into multifamily investing and coaching others to do the same?
Yeah, so it's kind of funny how I got involved because I got involved in real estate and multifamily by actually someone approaching me to become a passive investor, which is a lot of what we're going to talk about today. One of my friends had gotten into real estate. I was in the engineering world, corporate America, and I was watching him from behind the scenes. And one day he came up to me and said, "Hey, I'm doing real estate, right?" And I'm like, "Yeah." He goes, "If I next time I come across a good deal, is that something you might want to take a look at?" And I'm like, yeah. I'm like, I was so excited because I've always wanted to get into real estate. He didn't know this. He didn't know I was watching him the whole time, and I was a little jealous because he was creating this passive income stream on the side of his other job. But then he invited me to take a look, and that's what really kicked it off. So I took a look, but I was so interested that I started paying attention what was online, watching infomercials, taking it to the next level. And it's funny. So we got started, and I said, well, why don't we do this? Why don't we go to this seminar and check this out? And so we started educating ourselves and looking at some seminars. And then that really kicked things off because they told us one of the most important things there that we both of us didn't know. We didn't know anything about real estate, or he knew more than I did, obviously. But they said, go to your local real estate club meeting. Go to your local real estate club meeting. So we both wanted to get out of corporate America at that time. So we went to three of them. We tripled everything they told us to do. We tripled it because we were motivated to do it. We, in our early 30s, wanted to really kick it off. So it's funny. We went to three of them. The third one we went to was over an hour away. And that's where we met Dave Lindahl. And we got to know him well, contributed to a lot to the real estate club. He's like, who's doing deals and want to talk about them. And we really got to know him and actually took a lot of his courses. And that's how I got involved in actually real estate investing and then get involved in the coaching. We really hit it off with him when he started his coaching program. He said, hey, I want you guys to be my first two coaches to coach in this program. And here we are almost 20 years later.
Great segue. So you've coached hundreds of people over the years. What patterns have you noticed or picked up on those who succeed in multifamily and those who struggle? What do you see?
Sure. Yeah, it's mostly the commitment. Everybody wants something, right? I mean, if someone wants to lose weight or they want to lose, get a lot of money, they want to be wealthy, but they're not willing to make it a priority. That's one of the biggest things. They treat it like a hobby instead of a business. That's where I see people that are struggling the most, or the patterns I see. They don't start in what I coach on is really, hey, the first thing we need to do is we need to see how much time you not spend, how much time do you want to invest on in your real estate business. We have to start with that because that's the time you need to put into your business. What's the minimum amount of time you're going to invest every week? And then from there, we can decide, hey, what are the main things you need to do? You need to have a business meeting every week. And then we have to have goals. So we can work backwards and we can have some metrics to hit those. So it's not the real estate part that they struggle with. It's really dedicating time, being consistent, and actually treating it like a business versus a hobby. You can't do it in your spare time. Why, Brian? No one has spare time. I don't care. My mom's retired and she's been retired now, I don't know, for 12 years now, whatever it was. And she doesn't have any time. Every time I call, she's busy. But you ask yourself, busy doing what? Right? So you really have to commit to treating it like a business. The great thing is you can start it out part-time if you want to, but you have to do it. It's those personal development things where they struggle the most.
You mentioned time, right? And no,
Yeah.
they're not making any more of that, just like they're not making any more land.
Yeah.
Your previous episode, towards the end of it, you mentioned your calendar and just some really simple processes that you use
Mm,
to track your calendar. And just, I think you said something
yeah.
like if your calendar wasn't full, I'll paraphrase here. If it wasn't full, you're a fool. You didn't say that. I said
Yeah,
that.
that's what you were thinking after.
Yeah. So
Yeah, huge.
so here we are, right? After
Yeah.
years of coaching, you're back in the game now. Why did you recently decide to ramp back up and start investing again? And why now?
Yeah. So I'm always presented with opportunity. I've been very fortunate in my life where everything I've had, I never had to, even when I got out of college, didn't have to apply for a job because people came to me because my work ethic and so forth. So I got this opportunities along the way. So I did that Flag for Hope project for 2 years and I traveled to 35 states, along the way, getting to meet hundreds and hundreds of people. But I was doing that on the side of my coaching and my educational business. Then I was also doing health and wellness as an opportunity with a paradigm shift in that. So I had other things. That's why I do real estate, right? To have options, to be able to do what I want to do. And I like to have my hands in different things. So I was doing those and enjoying them, but things had slowed down a little bit. The Flag for Hope project ended, and my other business I wasn't spending as much time in. And I was also looking at, my 401k and talking to my financial planner. And I already have investments in real estate, but I said, you know what? I'm tired of making the 8 to 10%. And I tell them I don't want to be super risky. I'm like, I'm in my early 50s, so I'm like one step below super risk, right? But it's always 8 to 10% return or 8%, 7%. You're paying the fees. I'm like, all right, I'm done. I said, I know everything about real estate. I'm going to put more and more into that because typically, you're going to be making, now I can make somewhere, anywhere from 17 to 25% annualized return, depending on the property and so forth. Ramp things up a lot faster. And I was just discouraged. I don't want to invest in the stock market. There's been so many fluctuations with different announcements being made, then all of a sudden the stock drops out and so forth. So I said, I'm going to start getting more involved in real estate again, and take more of an effort there. So I started invested for about a year. And so that's why I got started now, is to really start looking at the market. The market was, right after COVID was changing quite a bit. And I believe that the market's going to be moving forward. We study emerging markets, right? And looking at places that are growing. So now that kind of things settled out, because that disrupted things a lot, right, Brian? Because of the stay-at-home people, right? They get to work at home. It shifted a lot of dynamics after that. So it was challenging for a little while there. But now I see a pathway where things are growing, and so that's why I started investing again.
So you had personal experience, well, previous personal experience as a real estate investor. You saw
Yep.
that, you knew how it worked, you knew your returns, and then it was like, okay, I'm okay now. And then you saw what the stock market was doing. It was like, no, this isn't where I want to be, and it's not giving me what I need. So
Yeah.
that was, I mean, those two drivers, you already knew real estate. This was not a new learning curve for you. This was
Oh,
flicking a switch, and
right.
you saw that 8 to 10% just wasn't bringing you where you need to be, because we go right back. We can't create more time.
That's right. And here's another reason too, is I didn't want to get back in full scale, meaning finding the properties myself, and so forth. So that's another reason I was looking, once I found who I wanted to invest with, as I was, or decided who I wanted to invest with, then I took it to another step where I started getting more involved with them.
So in the green room before we started recording, you
Yeah.
mentioned you now have a venture with Viking Capital. So you
Yeah.
mentioned the strategic partnership with Viking Capital.
Yeah.
Led you to join forces with them, and what makes that as a partnership so powerful?
Yeah. Well, as you can imagine, I've seen the good and the bad and the ugly. There's nothing that doesn't have some risk, right? I mean, there is risk in real estate, but we mitigate it, which is great. And there's a lot of advantages to real estate. But the deal is only as good as the partners you get involved with and the communication people have. It's a big part of it. And for me, I did start with Viking Capital. So these guys, Vikram and Ravi, they started. I coached them to over 10 years ago. Probably what do you remember the years that you were in the coaching program? I know it was a while ago now.
Yeah, we were living in Massachusetts back at Groton at that point in time. And Viking Capital, when you mention them, it's like my visual recall drives me
Mhm.
crazy.
Yeah.
Remember a business card with, one of those Viking ships on it, and I think it was
Yeah.
yellow, blue, or gray, something like that.
hmm
I
So
know
you're thinking
that.
around it.
Yeah, I've met these guys before.
Yeah, I think it was around the same time that you were part of the program, slightly before or after. But anyway, I've known them for 10 years. I coached them 10 years ago. I saw them starting out. I get to see them behind the scenes making decisions, how they worked with their brokers, their property management companies, how they worked with their investors, and how they treated people, their communication. So I was getting advertisements from them, and I watched them grow, and they had grown to do over 6,500 units. Their track record is they hadn't lost any money in the last 10 years. They're all about capital preservation. And, they've done $1 billion in assets. So that's how I determined, hey, I want to reconnect with these guys. I reconnected. I love the communication. And then I started investing. So I invested with them for about a year. And then what happened was is I said, hey, you know what? I want to get more into the business again, but I don't want to do the whole thing as I was mentioning earlier because at times I love my coaching. I think I'll always coach. I can make my own hours, right, and take on as many clients as I want. But I also wanted to get back into and more knee deep into the real estate world. So I said, I'm doing it with these guys. So I asked them, I said, hey, do you guys ever do strategic partnerships where if I was able to raise funds for you guys, then we could, I'd get a, cut of the deal, or we could work something out where we could partner somehow. And they said, absolutely. So we worked something out where I raise funds for them. I have my own fund that's created specifically for their deals. But the main thing is because I felt like I could trust them just based on, because I invested alone. Obviously you can imagine I got a pretty big real estate network. But before I want to bring anything to anyone, I want to vet it myself. I wanted to test it out and to put my own money in there. So, but once I saw it and I was blown away. I was blown away with, they have a team of 10 people behind them. They just when I needed something, they treated everybody the same way, no matter how much you invested. And I just fell in love. I told them, I said, we're cut from the same cloth. That's why I wanted to know if you do this, because I might not even take this or do this unless I do it with you guys. So that's kind of how I joined forces with them. And it's been great ever since I did.
So you vetted them out, and I'm sure when you proposed this idea to them, they were blown away because let's face it, Don, you're a rock star in yourself. It's like Mick Jagger asking to join your band. It's like, oh,
Good buddy, Ryan.
let me think about. Okay, we'll take it.
Yeah.
So yeah,
Yeah, it was great, and it's funny because I was working with the VP of Investor Relations after I reconnected with both the founders, and and then we really hit it off on both sides. They knew what they were getting, I knew what I was getting, right? Because I've coached them before they had these accomplishments. I'm not saying that I did it for them. They worked hard, they did it, but they knew what I did in my credibility within even our Mentor organization and being there 20 years with that many students behind me. So anyway, it's been going really well. I'll do more with these guys moving forward. We went to a project in Phoenix back in April. We're breaking ground on, and we talked about that at some point. What other things and how can I be more integrated with their business? So I think I'm excited about that. Whether it's I don't know, consulting or whatever, just because we talk the same language, obviously.
yeah, and I mean, you were my coach, you were my mentor as well. So I'm sure these guys saw your work ethic, say, okay, this isn't just a guy here. This is a guy who trains other people to do what we're trying to achieve. So
Yep,
we're not going to have to educate him or ramp him up. He's
that's
going
right.
to come in and, he's going to be calling the plays just like a coach should be doing. So it's like, wow, why would you not do that?
Yeah, well, and it just, so yeah, and timing is everything, and that's what it just was. Everything started coming together, and it was the right timing. I was excited about doing it, and so at some point, I can see myself doing a leadership role with even on the investing side of things with them. So I'm just taking it as it comes and enjoying the journey along the way. And I like having options, and that's the beauty of it. I don't have to I'm not an employee, so it's leverage for me. I can take on whatever deals I like. I don't have to raise money for all the deals. It's the one that I want to would take the time, or if I'm jammed up with my other businesses, I say, I'm going to skip this one. I'll focus on the next one,
Yeah. That real estate gives you options, of course.
Yeah.
So this next question, I kind of want you to speak to the audience here, right?
Okay, sure.
They may or may not understand some of this. So I'm going to be asking you a question, but I don't want you to be answering me. I want you to explain this to the viewers.
Sure.
So
Okay.
For someone who's new to multifamily investing, especially as a hands-off investor, what exactly, or how would you define a limited partner, and how does that work?
Yeah, sure. So a limited partner is an equity partner that comes into a real estate deal. They invest money, but they don't have any responsibilities. They don't participate in operations. They're just a passive equity partner. They invest their money and they're going to get a return on their money, just like they would if they put their money in a CD or a stock or anything else, and you're going to get money from the investment. So that's the nice part about it. So it's hands-off investing where you don't have to buy a property to get that passive income, because most people, that's what they'll do. That's all they know is they go out and they'll buy a property, and it's not really passive when you buy it yourself, right? I just call it leveraged income when you're buying the property, because you're going to manage the tenants, and if you're doing your own management, unless you hire someone like Brian to do your management for you, but you still have a lot of other responsibilities. It's kind of like a whole business, but it's leveraged income because you're not there all the time. This is totally passive, where you put your money into the deal, you invest your money, and then based on how the property performs, you're going to get a cut of the cash flow and a percentage of the cash flow and a percentage of the profit on the back end. So you're an equity partner.
Great explanation. So again, for the viewers, people who may not understand this whole thing, you and I know why multifamily, but
Yeah.
for someone who's saying, well, maybe I want to do this, or maybe I want to do this, and we've all been there, right?
Sure.
Like 15 different programs on the shelf, and it's like just shiny objects.
Yeah. Yeah.
So what makes multifamily, and we know the answer, but what makes
Yes.
multifamily one of the safest and most consistent ways to generate a passive income, even when the markets are uncertain and you don't know what's going on? Why multifamily?
Yeah, well, my biggest thing, especially with any type of real estate, is because everyone needs a place to live. And that's what drives the demand for apartments, is everyone needing a place to live. It cash flows when you buy an apartment, right? It's cash flowing. It's a business that's already got started and it's cash flowing. So you have some track record, because every time we buy a property, it's like buying a new business. So you're seeing how it's performing. You get to see kind of the past a little bit. But the main reason is because it's everyone needs a place to live. That's why I like multi versus if you get in a commercial, storage, mobile homes. A lot of my students always ask me that. And, there's pros and cons to all those, but that's the biggest thing that I love about multis is they need that. And for the multis to change, it's not like, if you want to compare it to there's not many places that you can get a great return like multis, over a double-digit return like you can in multifamily, right? I mean, like I said, mutual funds, I'm even seeing it with my own professional advisors getting 7 or 8% after I pay the fees for my retirement account going into mutual funds. Yeah, you can make a ton in stocks. You can go up fast. You can lose everything overnight. Real estate's more steady. Rents aren't going up and down every day. Yeah. Can there be one-offs like COVID happened and some things happened in different areas? People moved and migration, but those are few and far between. But most of the time, your rents, we mostly invest in what we call emerging markets. So that mitigates our risk as well, because we're looking for places where things are improving. Job growth there's more job growth, more population growth. That adds another level of mitigation for multis. And if you're investing in stuff and you're looking to make returns on your money and you're looking for a place to place your money, one key advantage of multifamilies is the depreciation. even though you're a passive investor in a deal, like if you own your own property, obviously you get the depreciation on your taxes, meaning you're going to get more tax write-offs. But if you're a passive investor, you also get those. If you're an equity partner or the limited partner, you're also going to get to share in that depreciation. So typically, a lot of times, all the cash flow you're getting, say if you're holding the property for 5 to 7 years before you sell it, you're going to be able to get that as tax deferred because of the depreciation. So you can't get that in other types of investment vehicles.
Wow.
Sorry, did I say too much?
No, no, no. It's like for anybody who's never considered multifamily, hit pause, rewind, and listen to everything Don just said again. And yeah, it's like I'm going to do that again because yeah, so
We
many
forget sometimes, right? I even forget how wonderful it really is, when you until you say it.
right. And like you and I, we're in the trenches.
Hmm.
I mean, Don, honestly, you're probably going to have forgotten more about multifamily than most people will ever know.
Yeah, I agree with that. It's already started happening.
So once the water spigot turns on, it's like, oh, can I have a drink of water? It's like Don's got like a fire hose here. It's like, oh, let me just give you an answer there, just a like simple answer.
I'm trying to hold back because I don't want to overwhelm people too much.
No, and I can hear how excited you are when you talk about this, and I
Yeah,
hope the viewers get that as well. So, going back to the viewers, NLP, general partner, all that. How important is the sponsor operator relationship when it comes to passive investing?
huge. It's huge because it's how the deal performs, right? They're protecting your investment. They're running the property. They're in control of operations. Unfortunately, out there's people that always don't do the right thing. It's in any industry, right? So a lot of people talk a big game, but they don't follow through. You get their money, you don't hear from them. They answer every question every single day, and then you invest your money, and then you barely hear from them. It's hard to get in touch with people. And again, that's not just real estate; that's in a lot of different things. So the people that you get involved with is super important. To me, the number one thing is communication. And that's why it's very hard for me to decide or to even want to go out and partner with someone because my reputation is everything to me. There's a reason I was at RE Mentor for 20 years. I don't bounce around. I find a home and I stay there if I really like someone because, that's yeah, I want that track record. I like what I do, but I want to be associated with the right people because integrity is super important to me. I mean, to have relationships, to be able to Brian to reconnect years and years later after I coached him and like not miss a beat. I love that, and I love to see their progress. But to get back to your question, is visibility, communication, transparency. It's okay. It's not perfect. It's okay. I want to hear the good, the bad, and the ugly, especially if I'm bringing investors into someone's deal, because I want to be transparent with them. And that's what I found as an investor myself with Viking is they were doing that with me. So I'm like, good. I'm glad you tell me all this and they weren't afraid to. They were happy to tell me that because this is reality, right? And I knew I'd be able to convey that to my investors. So yeah, very important on who the sponsor is that you're getting involved with. Some level of trust. If you don't know them, then do a little vetting. Look online a little bit, see what's about them. What's their track record? Ask them the questions. I trained some of my investors that got involved with me, and they were still looking at other companies. And one thing they learned is they said, "Hey, I would have never asked this question," but they said, "Hey, have you ever had capital calls?"
Yeah.
Right. And they asked the person was transparent, which I think is great, that they did because sometimes things happen. But anyway, they said they really liked that they could ask it, find out the story behind it. So that way you can kind of see how do people asking some tough questions. So that way you can see how do people operate in certain conditions.
Yeah, really good stuff. Because a limited partner is someone who comes in with money, and to sum it up, they're going to write a check, and their expectation is to write a check and get a bigger check back.
Yeah.
General partner, they're the one driving the deal. They're the one in the driver's seat. They're driving the bus. We had Brian Burke on the show a while ago. Really, really smart guy. Actually, one of our first billionaires on the show.
Oh, wow. Holy cow. Nice.
Yeah, and he wrote the book, The Hands-Off Real Estate Investor.
Oh, cool.
He wrote that book for limited partners because one of his friends, a woman he know, lost her entire life savings going in on a GP, and he didn't want to see that happen to anybody else. And he wrote that.
That's awesome.
And now he's actually back buying properties again. I mean, everyone that I've interviewed who's been on the sidelines waiting for the market, boom, boom, boom. And now even yourself and even
Yeah.
myself,
Yeah.
they've got that dry gunpowder waiting for the market to shift. And, even one of my maintenance guys came in today. One of our clients is selling a property, having a conversation with the realtor. And my guys, they're really smart. They must listen to me or something.
They should.
Well, he was able to like sputter off some of the things that they've heard me say to this
Sure.
realtor, and the realtor's like, yeah, the market is changing. Yeah, inventory is coming up. Yeah, we're seeing prices start to drop a little bit. And I was at RIA a couple of weeks ago, Real Estate Investor Association, and the discussion, there was an analyst up on the board saying, yeah, inventory is coming, this is this. And, you and me, this is like our third cycle.
Yes.
I mean, we can smell the blood in the water right now. We know what's coming.
Yeah. Mhm.
So there was a gentleman standing behind me who probably hadn't been through the cycle and says, yeah, I'm flipping homes. And, we used to be able to get above ask. And now we're right at our numbers for what we're able to sell property for. And he's saying to the room, it's like, yeah, it's going to stay there for a while. Don,
Wow.
you and
Yeah.
I know it
Yeah.
doesn't stay there for a while.
That's right.
As soon as that trigger goes, all the cantaloupes, all the cantaloupes, all the antelopes,
Yeah.
not the cantaloupes, all the antelopes are running like they just got spooked, and boom, now all the sellers are like throwing their properties on, which,
Yeah.
what is it? It's July 29th,
Yeah.
2005. This is probably going to air September.
Yeah.
It'll be interesting to see where the market is, because right now, you and me talking, I think it's coming, right? The
Yeah.
the knife is going to fall fast. And
Yeah, well, the thing is, people have been holding off for a long time because of interest rates, right? To sell because they want to get higher prices. They've been thinking they're going to come down, so people can pay more because they'll get more cash flow. But yeah, as you know, in commercial, they're 5, 7, or 10-year loans. You can only wait so long, and that's one of the things I think that's going to speed up the process because they've already been waiting a couple of years, kind of trying to hold out. Their properties are performing okay. They just want to get that upside on the back end. So yeah, we'll see what happens, but that's happening there. And they're also happening is some markets are oversupplied right now, which is okay as long as they're getting good migration into there. And that's kind of what we've been looking at too, is new development projects because of that, because of permitting and so forth.
yeah, I've been following Ken McElroy a lot. Now he's
Yeah.
buying again, and
Yep.
um, he's got some really interesting ideas. He's coming in on properties. I mean, the deal I'm doing tomorrow is 80/20. I got to put in 20% because of what you taught me, credibility,
Hmm.
know what I'm, or I like to think I know what I'm doing. I always go,
Yeah. Of course you do.
but he's going into these deals at like 40/60. He said if it's a really huge deal, he's going in 50/50. So for the viewers out there, that means he's putting a 50% down payment. Why? Because he sees the market is jittery, and he's going to be secure because if the market does drop, at 50%, he's still going to be 20, 30% above water if the market gets funky. So
Yeah.
we talked about GPs, we talked about LPs. And again, for the audience, what you've mentioned a lot
Yeah.
already, but if you want to sum it up, what should a
Sure.
new limited partner be looking for in a sponsor when they vet a deal or vet a
Yeah.
sponsor?
Yeah, well, they want to look at the sponsor. They also want to look at the deal, because you don't want to get in a deal that's, maybe that it's more risky if you get something 50% occupied, right, Brian? And you got to turn it around and reposition it because the track history is not there as much. So it's a heavier lift. You have to be very good at management. So I would say to mitigate your risk, go with a stabilized property, something that's already cash flowing out of the gate. Make sure, like Brian just said, low loan to value. Don't get in with something 80/20 if you can get into something that's 70/30. Just there's more equity in the deal. So if things don't go as planned, there's more room. Debt coverage ratio, right, Brian? Another
Yeah.
great metric to look at, banks will allow you to get Fannie Mae, Freddie Mac financing at like a 1.25. Now, not all of you are going to know this, but 1.25 debt coverage ratio. And if you can get in higher than that, 1.4, 1.5,
Yeah.
then again, it's another mitigating risk. It shows that you have more room. But yeah, so with the deals, that's some things to mitigate your risk. You see if you like the market that it's in. Is the market growing or is it declining? You can look that stuff up yourself. Job growth or population growth in certain cities, just to see what direction, what's economic development doing. What are they saying? Is there anything positive going on there? Because at the end of the day, it comes down to basic supply and demand, right? If it's too much, there's too much supply, then rents go down. If there's not enough supply, rents go up. That's a very simple, it's not the only thing, but it's a big um, macro level piece that you can look at.
So there's a lot of savvy investors out there. They've been waiting on the sidelines. Now they're jumping back into the game. So someone who's jumping in the pool the first time here, what are some of the most common mistakes or assumptions you see a new passive investor make when they're getting started? And just talk directly to the audience on this one.
Sure. Yeah, the thing that you want to look for out there, the biggest mistake is don't always go for the highest return, right? Because it's more about the sponsor, who you getting involved with, because they're the ones that are going to hit that return. Anyone can put anything on paper. I can make the numbers look as good as I want. Do they make sense? Is more of the question. And if it sounds too good to be true, a lot of times it is. So just don't get involved in a deal because of the numbers. That's one of the biggest things I see that people make. And look around. Like I said, do a little bit more of your due diligence on your own, so that way you can make a better choice on who you. Because I've seen people, and blows my mind, like they would say that they just met the person online and gave them $2 million. Yeah, yeah, I've seen that. And going to some of Dave's events and talk to people, and they like, oh, I came here because I had to do this because they met him on Craigslist. I'm like,
Oh
you
no.
know. But look for people that are online that have exposure, people that have experience in the industry. They're not, I've been doing it 20 years. I've been involved in the same coaching company for 20 years, educational company. Obviously, Brian came out of that. My other Hall of Fame students that I partner with, they came out of that program with Ari Mentor. So get people that know they're out there, that have social media, have a website, have visibility, because they have something to lose, right? Our credibility. We want to do the right thing because we have done the right thing. Otherwise, we wouldn't have stayed with people for so long. So look for that. How do they know the partners? There's a lot of people out there, Brian, that go out there. Here's a great question to ask. They go out there and they raise money for other people, sort of like what I'm doing, but they just met them at a real estate event. That's the big difference. They didn't know them, they didn't coach them, they didn't know them for 10 years. They just met them and they wanted to raise money for them. And what I see a lot, and I'm blown away by it, is those people don't invest in their deals. They're just raising money, but they're not putting their own money in. They're not going through the paperwork. Oh yeah, it happens all the time, Brian, all the time. I can't tell you how many times I've seen it. So one question you always ask is, are you investing in the deal? And I invest in every single deal I get involved in, because if it's good enough for people I know, it's going to be good enough for me. And I don't care if it's 10,000, 20, no one wants to lose money, right? So it doesn't matter if they're putting like 500,000 in, but you want them to put something to know they have skin in the game and that they're going through the similar process that you're going through. So that's a huge nugget to see, because I see that all the time. It just happened recently. I just was talking to someone and they just told me, because they're having some issues with the person that they were investing in. And they said, I just found out they didn't understand the paperwork because they didn't put any money in. I'm like, are you kidding me? So yeah, a lot of people, you just don't know. You don't know what you don't know. So these are nuggets. Take these to heart. Listen to this twice on some of the things I said. Write them down like your little checklist, because they can make the difference between you making doing really well and not.
Absolutely. And I want to add to what you say here.
Yeah,
It's your money, right? You worked hard for it. You're going to invest it. I don't care if it's crypto stock, gold, silver, or goats. I don't care.
yeah,
Don't be afraid to ask questions, right?
yeah.
You
Great
know,
point.
you know what you knew to make that money. Now you're putting it into the hands of somebody else and you're trusting that they know what they're doing. Don't be afraid to ask questions. Okay, don't be a pain in the butt, but understand what you're investing in. Ask the questions. And if you don't know, say, hey, could you explain that to me? You mentioned something else really important. You meet up with someone that first time and they wrote a check for 2 million. If I thought I might invest with someone, I'm probably gonna stay in the wings 6 months to a year. If they're gonna present the deal to me, it's like, okay, maybe not on this one because I'm tied up in something right now, but follow that deal. See how you had a great question. Did you have to do a capital call, right? Did you have to
Mhm.
do this? How did the deal turn out? Wait for the end of the deal to see how it turned out. Then you've got a little bit more track record on that GP where next time around, next time they have a deal, it might be something that you can join them on, right?
Yeah, that's great advice. Even, yeah, take a look at if you're not ready, or don't put all of it in there. If you only have 2 million, put in 100,000 to get started, so you have some of it left to do that. But yeah, that's a great way to follow along or bring them through the deals. And just because someone had a capital call doesn't mean it's a bad thing. Things happen sometimes. See the reasoning behind it. What did they do about it? How did they treat the investors? Did they stay in communication with them? And what did they learn from it? Because it's not a perfect world out there.
So, what types of strategies would you recommend to help a new investor mitigate some of their risk when they're entering a first deal? What type of, I mean,
Yeah.
what should they set up? What should they be thinking? What should they be doing?
Yeah, so understand what your risk tolerance is. That's one thing, right? If you've been only putting money in CDs all along the way and you've never been involved, ask a lot of questions. I just did this with someone that I knew. They were been watching what I've been doing and asked me about it. And they asked, what are the risks? And I shared all the risk with them. So they weren't afraid to ask questions, which was great. But you have to understand your risk tolerance. A CD, you don't lose money. You only make 4%. The stock market, some people have the stock market or they get into options. They're more on the risky side. So you're looking for a solid investment, so know that you're okay with that and what the plan is and how does it work, and ask them what the sponsor sees as any of the risk with the deal. But educate yourself. There's great things. I mean, I post and a lot of other people though on LinkedIn, educational stuff, LinkedIn or Facebook, so where you can educate yourself on, hey, what are the top, and do some searches. What are the top 5 mistakes? What are the top 10 mistakes? How do you become LP investor? What should you look out for? There's just little tips and nuggets that you can learn. It doesn't mean you're going to take a course on it, but just, macro level stuff that if you do that, you're going to significantly improve or mitigate your risk. But you can stop by doing that. Look on it. As soon as you do a few searches, unfortunately, it's double-edged sword. You start searching some of this online, and then all of a sudden you're going to get all the articles sent to you, right? Because it's all the algorithm out there. But that's the biggest thing. Educate yourself a little bit so that way you're more familiar with it and what to do, what not to do. And like Brian said, one of the key components, ask a lot of questions and know who you're getting into business with, because all sponsors aren't created equal.
So you bring up some really good stuff, and I remember sitting with my CPA once, and he says, "Well, aren't you ever going to think about diversifying?" I says, "I do.
Yeah.
I buy lots
Yeah.
of properties."
Yeah, that's true. That is the diversification.
So, that's a funny little story, but I want to add to that a little bit, right? You mentioned, I took some notes here. Your first deal, you don't want to go all in with your whole basket of eggs here.
Yeah.
Diversification, what does that look like? I mean, a younger investor can probably assume more risk, where someone at my age, I want to see maybe a lower return, but lower risk as well. All right.
Yeah.
Something a little more solid, steady.
Yes.
So, what does diversification look like as a real estate investor? Maybe you cut up your nest egg into 5 pieces. Maybe these two, you'll do something a little more risk adverse that'll give you a better return if the deal works. And then something a little bit more stable, so you've got something solid. So yeah, diversification usually means do some of this, do some of this, do some of this. But for me, even in multifamily, it can stay as multifamily. And depending on the risk, depending on the sponsor, depending on the deal, depending on the emerging market, you could diversify out that way as well.
Yeah, no, that's great advice. And look for more cash flow. Usually the more risk adverse is less cash flow at the beginning and more in the back end. That's why, if you have something that's a vacant property or 30% vacant, you'll see that a lot of them out there, they have higher return overall, because you're taking more risk on it. The ones that are cash flowing more, they have more of the track record. They're more stabilized. So those are less risky to get involved in.
Yeah, it may be more steady cash flow, but not like a gushing stream.
Yeah, but if it's still showing 17, most of them are going to show 17, 18% average annualized return or projecting that, because again, it's not a guarantee, then that's better than anything else you can get out there. Even if it didn't hit those numbers, you hit 15. Where else can you get 15% beside crypto or the stock market? But again, those are a lot more risky, in my opinion.
Risky. So if someone doesn't have a lot of time or doesn't have a lot of experience, but again, they want to build wealth through multifamily, what would you suggest? What would the path be, the first steps they can take to get started?
Yeah, I would educate yourself, as I mentioned earlier. That's one of the things. If just learn a little bit more about it online to start out with, and then as I mentioned before too, is that on Facebook, LinkedIn, I know I receive stuff all the time. I'm putting stuff out there because I want my investors to be educated. I want them to know what they're getting to, and because there's plenty of money out there and there's plenty of investors, and you want it to make sure it's a good fit. So I would say you even go to your local real estate club meeting. You can meet some local people there, get educated there, listen to people, get more familiar with the industry. And one of the big things I want to also add, Brian, is when you are talking with someone that you might be interested in their properties, you want to ask them, hey, what has to happen to hit these returns, right? Like there's certain things, if it's a value add component to it, there's certain things that have to happen. So you can kind of see, hey, how realistic does this sound? So, but that's what I would say. Educate yourself, stop looking online for people, and you might find that you have friends. Like on Facebook, it shows you might see someone's advertisement on there, just or educational piece, and you can see, do any of your friends follow this person? Maybe they've already invested with them before, right? And that can, again, be on LinkedIn, Facebook, see if you have any direct connections, because referrals are great, right? If you have someone that already knows this person and known them for a while and knows their history, that mitigates your risk huge, right? So I think that's really important.
Really good starting steps there. So absolutely educate yourself, milk your network, find whoever you can. So here we are, right? That newbie or somebody who wants to do this, they don't have the time, they don't have the experience. They've been educating themselves, building the network, building it up, building it up, building it up. Analysis paralysis is real, right?
Oh yeah, huge.
You can get to this point of absorption where you don't even know which way to turn. Your head
Sure.
could be exploding with knowledge. So how does somebody know when they're ready to invest with a limited partner? I mean, is there some mindset or trigger, financial readiness component? I mean,
Yeah,
what's that point where, okay, I stopped reading all the articles, I found somebody and I'm going to jump in?
sure.
What would you recommend as a plan of action?
Yeah, well, the thing is, it's about options, right? That's why a lot of people look at different things. It's what options do I have to make a similar return that is, what I look at and why you invest as well. I look at real estate. Hey, I have a hard asset, something I can feel and I can touch. It's not a piece of paper, right? That's a mitigation to me. Having something to invest in that people need a place to live. That's something they're always going to need. Commercial buildings, a little bit more challenging because businesses can go to business, more stuff sold online. So you got to ask yourself, what other options do I have? I can keep my money in a CD, or I can put my money in mutual fund and make 8%, and or put it in the stock market, make this. Where does it fit in? But say I want to be what are your goals? If I want to make and build my retirement or nest egg faster, let's try a portion of my money, put it in. That way you are mitigating your risk. You're not putting a whole nest egg. So that's something you could decide on. But that's what I would say. When I was talking to my friend that had the money in the CD, we had about a 40-minute conversation. By the end of it, he's saying, why doesn't everybody do this? And I'm like, because not everyone knows about it and knows that they can do it, or knows someone that they could trust to get involved with. But yeah, so those are the things that I would look at, is just lay down on a piece of paper, pros and cons list. What are my options, and what each box, and how is each risk mitigated?
Okay, so the guy who wants to get started as an LP, he educates himself.
Yep.
He identifies his buy box, his risk returns, what types of assets he wants to be in. And then once he nails that down, when he finds a match, jump in.
Yeah. And yeah, I say that's the best way to do it, or the quickest way to do it.
So now I want to turn the spotlight back on you, right?
Okay, sure.
You've been through this process. You are pretty much on autopilot because you've got experience, right?
Hmm.
That one component somebody starting out doesn't have. Uh,
Hmm.
Time, we only have the same amount of time. So could you talk about a deal that you've maybe recently done that or that you've invested in? What attracted you to it, and why for you? And everyone's going to have a different answer. But what
Hmm.
attracted you to that deal, and why did it work for you?
Sure. So yeah, the latest one of the latest ones we did was actually in Atlanta, and it was property was Avondale Hills. And one of the reasons, or there's a bunch of reasons I got involved in that one, we're getting it significantly on the market, so there was built-in equity to it. It was a newer property. We were buying it from a builder. So, newer properties, obviously, it's not 1970s, 1980s. It's brand new. So a lot less deferred maintenance and issues that can happen and things you have to deal with or mitigate. So that was really important to me. In that particular deal, I like that it was newer. And I also like it's a 3-year hold project. I'd rather hold 3 to 5 years. Some people like 5, 7, 7 to 10. I like to turn the money over. And a lot of times what happens is this property was like at the time 90, a little bit more than 90% occupied. So it's cash flowing very well in a great area, and that's growing. And so those are all the things that I really liked about it and why I got involved in the deal. Plus, there's great bonus depreciation, which I'm not going to get into, but there's, bonus depreciation that's been happening in the last 5 years where you get to depreciate the property faster, and so forth. But I like that 3-year time range. Most time, if you're doing a 3-year project, it's going to be a new development project, or it's going to be a project that's a repositioning project where you're buying something below market because it's 60, 70% occupied. You have to remove a lot of tenants. You got to reposition, change the name of the property, rehab the property. Again, more risky. So when I saw this is a brand new build and the developer wanted to get out, they held it for a year. They're not into holding properties. It's because of the relationships of Viking that they got the property. I really like that component of getting a Class A property and have a 3-year hold projection. I always like to say projection because it's not guaranteed. You look at the market and you got to see if it's the right timing of when to sell the property and so forth. But 3-year versus a 5-year target is significantly less.
Wow, so smart. It was a stabilized asset, new build, 90% rented.
Mhm.
Value add wasn't really on the table because it was brand new. I mean, you might find a few things you could do, but there's no real big thing there. You did,
Built-in equity.
yeah, built-in equity. You did mention bonus depreciation, and in the new big beautiful bill, uh,
Yes.
we're going to be finding out more about that this weekend when I go down to Dallas. But I mean, I don't understand it 100%, but there may be situations where 80, 90% you may be able to do bonus depreciation. Of course, if you sell, then that's all going to come back to you. But
Capture.
for your operations, I mean, a brand new build,
Yeah.
there's some nice stuff on the table there.
Yeah, with that one, and we closed at the end of 2024, and that one, for every $100,000 that was put in is $34,000 in passive losses and bonus depreciation in the first year, which is a lot if you sell a property because you said it's deferred, right, Brian? And eventually recapture, but there are strategies that you can do. Whereas if you buy another property around that time and you get the bonus depreciation on that one, you can offset it again. But we're not going to get into those advanced things.
Well, why not, right?
Oh, we could. I have time. I'm fine. Well, let's talk. I'm here as long as you want me to.
Yeah, I mean that's where it gets sexy and fun. I mean, I tell my sons all the time,
Yeah.
investing is boring, right? Find one
Yeah.
thing to do really well that you understand. It's not glitzy, it's not sexy, but when you start to layer this on and then layer that on and layer that on, these other features like seller financing or bonus depreciation,
1031 exchanges, right?
1031 exchanges, or Delaware statutory
Yep.
exchanges. That's a new thing that I just found out about, which is
Yeah.
really sexy, right?
Yeah.
Now it starts getting fun. But anybody who just heard us rattle off 3 or 4 bullet items, who not sure what those are, educate yourself, right?
Yeah.
Get educated. I mean, we've got some shows that have covered some of that stuff. Or there's this website. What's the? Let me think of the website. It's google.com.
I think I know that one.
Yeah,
Yeah.
you can go right in there and type in.
Chat GPT, right? All the AI.
Right.
One thing we didn't talk about that I wanted to mention too, like you say, why real estate is think about knowing what type of investment you're getting in. We have no idea what's going on inside of corporate company for stocks and mutual funds. But if you think of a multifamily, what is it? Most people have rented an apartment, so they know what it's like to live in an apartment. It's income. What I love about it is pretty simple if you think about it. There's income and expenses and how much is left over, right? You're generating income for the rents, products, the real estate, you have expenses, you have a mortgage on the property that you have as expenses. And the better you run the property, the more income it generates, the more income the property produces. That's why we can sell it as a profit 4 or 5 years down the road, because along that way, we're increasing the income so we can sell it at a higher price, because multifamilies are sold based on how much income they generate, right?
Yeah. Cap rates, for anyone who's listening to this, cap rates are usually into effect when you're selling a property, not when you're buying a property.
That's
So,
right.
a lot of people make that mistake. They're going in,
Good point.
they'll ask the broker, oh, what's the cap rate when they're buying a property? It's like, well, that's not your exit. That's not where you're coming out of the deal. That's where you're going into the deal. So, and
Yeah.
again, these are some terms that maybe that newbie may not have heard before. So
Yeah.
definitely get on Amazon or Google or Barnes and Noble, and just start typing in some of this stuff and educate yourself. For 20, $30, you can sit down with a book or an audio book while you're driving and just
Yeah.
feed yourself some good information. I mean, I was
Yeah, even on here, Brian, right? Every time you have a podcast, people learn different things. I mean, I don't know if you have people send stuff in and what they want more of with your podcast as far as what they want to learn about, because obviously you have a wealth of knowledge that you can share on all these topics.
Yeah, I'm trying to chase the tail of the dog on that one. I mean,
Yeah.
I'm seeing the markets go around. It's like, okay, based on what I've seen before, what am I thinking about, and what should other people be thinking about? And that's what I'm trying to get out there. My
Yeah,
big
that makes
challenge,
sense.
the shows lag for about a month or so.
Yeah.
If you're watching some of the first episodes in season 1, the strategies we're spilling out then may not be as pertinent as they are now.
Yeah.
Like actually today, right now at this time, there's a hearing at the State House. Boston is trying to do rent control on renovated units.
Cool.
This came out in the last 24 hours, but what
Yeah.
happens in Boston will eventually trickle out to the suburbs and the other tertiary markets. So
Yeah, that's a concern when you're investing in, different states. There's more landlord friendly, more tenant friendly states. Depends if you're going to be a tenant, you want to be in the tenant states. If you're going to be a landlord, you want to be in the landlord states. It's just the way it is. So that way it's easier to run your property when there's less restrictions on you as the owner of the property.
So we've talked about a multitude of things here, types of deals, ways to educate yourself, risk variances, strategies, diversification, limited partners, general partners, so much that somebody listening to this trying to digest it all, their head could be spinning.
Sure.
Trust has got to be one of the biggest issues in multifamily. I mean, there's money being moved, there's people's lives involved, there's tenants. So
Huge.
I mean, for the audience today, what role does trust, or how does trust play into this type of investing? And how do you go about building trust and rapport when you want to partner with someone, or when they want to partner with you?
Yeah. The first is opening the door of communication, right? Reaching out to people, seeing how they react. And it's on both sides. Like as the sponsor, it's the same thing. We want to have good rapport with our investors because we are going to rely on them to send their money in if they said they're going to send their money in, right? So it's having multiple touches with people to get trust with them, right? Just like any relationship, you feel more comfortable over time. Being comfortable to ask questions to somebody, someone making themselves available. How do they interact? If you have a meeting scheduled, do they blow you off, or did they not get back to you for a week? If they're doing that, it's like courting. At the beginning, it's like a relationship, right? People are courting, during that stage on both sides. They should be on their best behavior, right? So you want to make sure you're starting to not just, you're qualifying each other to see if it's going to be a good fit. Do you feel comfortable with that person? How did you find the person? Did you find them through someone you knew? Or did you just find them randomly, like I said, on Craigslist, and then you're putting all your money into it, right? There's a big difference. So for me, building trust with somebody that's what I do, is I educate people. And I also try to do what's right for them. I had someone that wanted to come in, their first investment with me, and they known me for, not that long, a couple months, and they had like 600,000. They wanted to put 500,000 with me, and I didn't let them. I made them put 300,000, which might still seem like a lot, but I'm like, I know you want to put this. There'll be other good deals that come along. First relationship, they were asking me what they should do, and I said, I don't want you putting that much in. That's what you want to look for. Someone looking, I make more money the more money people put in, right? But I knew it wasn't the right thing to do. I'm looking for long-term relationships with people. I want to test out. I want them to feel comfortable. And that's what you're doing to build the trust. But the biggest thing is communication, having meetings, having a face-to-face, getting on a Zoom with them, seeing if anyone in your network knows them, doing Google searches on them. Those are all things that can, gain more trust, because you say, well, what's their track record? They've been with this company 20 years. They've been doing this. Even from, just say, I'll use myself as an example. I've been with Ari Mentor for that long. I've known Brian for 10 years, and we got back in touch after, and now doing podcasts together. Viking Capital knew for 10 years. So you can kind of see a history or a trend with whoever. Now, they don't have to have the same background as me, but you want to see some consistency and something that you can follow and research their names. It's amazing what you can find with just putting people's name on. I know most people don't do it, and you can see what does pop up when this person's name is put on there. So those sort of things. But trust is the number one thing. That's the number one reason I had to have trust in Viking when I partnered with them, because my reputation on the line, bringing friends, family, colleagues into investments. I need to know that they're going to do the right thing and how they operate their business. Well, same thing with anyone you get involved with. You'll have to do the same thing.
You mentioned something really, really important, and I want to put a spotlight back on that. You had an investor with 600K, wanted to put in 500K, and you actually advised them to be a little bit more conservative. Smart and good on you. And if that didn't build trust in the relationship, I don't know what would. It's like, no, please don't put all your money, because there's other opportunities. Maureen Miles, I know you know Maureen, right?
Oh yeah, coached her years ago too. She's awesome. She's incredible. She's done a lot of great things as well.
She mentioned something on her episode where it was the other side of it, right?
Yeah.
She had an investor come into one of her deals who put in like the majority of the income.
Okay.
And he turned out being a pain in the butt.
That can happen too.
So on one side of it, you're protecting your investor that they're not putting all of their life savings on one deal, that they'll be okay. And then on the other side of it, if you diversify your investors coming in, and granted, if you've been working with someone for 10, 15 years and they're going to come in and put in the lion's share as an LP, great, you've got that relationship. But even still, that trust and relationship goes both ways. If I'm a GP on a deal and someone's coming into my deal, I mean, it sounds good, don't put all your money in here. But the other part of it is like, we're in this deal for the next 3 to 5 or longer.
The relationship, it's a partnership. It's like getting married almost, right?
Well,
especially if they have some control, right? If someone's putting the whole amount, sometimes they want to have more control, or they do not just want to be passive. So as a sponsor, you're going to be careful for that. And a lot of times, say if they put the lion's share 75% and you get 25% of your other investors, you want to make sure that sponsor still has full control, not this other person that doesn't have any experience that puts 75% in. If you're part of the group that put in the 25, maybe there's five of you, because you need someone to be able to make the decisions, right? You need someone, and you want the person with the most experience. And that's what I share with my clients, that I teach how to build a real estate business. If they want to do the whole business, they want to buy the properties and so forth, they're raising money. I say it's just as important for you to get to know who you. It's not about getting the money. I've turned people down or just not shared deals with people because I don't want to work with them. I don't like the way they operate. They're not consistent. They could be abrasive, whatever it is. So it's not, you've got to think about that time frame and, your whole approach and what are you really looking for? I want to work with people that I love work at. I partner with a lot of my previous students that I enjoyed working with. We developed relationships. It's not everybody, right? That hundreds and hundreds of people, but the ones I did, I reached out to them, to see if they had any interest in doing it. People I knew already, but so yeah, Brian, that's a huge thing. It has to go both ways. And as far as the relationship goes, and you got to qualify each other to say if it's going to be a good fit.
Yeah, it's a really good question for the LP coming in. You don't need to know all the specifics of the other investors, but you may ask the question, I'm coming in with 300, the raise is like 5 million. Is there someone coming in on the deal that's going to have some power in the decision making as an LP?
Yeah.
Because that could affect that person putting in 300.
Yeah, absolutely. Yeah, that's another great question to ask along the way.
Yeah, and the problem with starting out here is you don't know what to ask when you're starting out because you don't know what you don't know.
Yeah. Yeah.
You've seen the good, the bad, the ugly, warts, frogs, and princes.
Yeah.
And you kind of get an idea if something looks like a duck, quacks like a duck, smells like a duck. It ain't.
Yeah. Well, that's the whole point of getting on these, right? People that are watching your podcast or any others is just to open your mind and to know what's out there and what opportunity, but also, to mitigate your risk as well. So that's what's great about this, is being able to go out there and educate people to do this and to give this to them as an option.
So I've got a really good wrap-up question. If someone worked real hard, they've saved their money, they want to invest, and they want to start having their money work for them without having to become a landlord, trash tenants, toilets, calls at 2 a.m, which I've never had a toilet call me at 2 a.m. So if somebody wants to do this, what do they need to know?
Well, they need to know a couple of things. First, you can do it with your money that's in your bank account or any money you have access to that's liquid, right? With the money you had in stocks or money market, whatever. The great part about this, a lot of people know this, I know you know this, Brian, but they can do it in the retirement account. So if you have an old 401k, you change jobs, you rolled over to an IRA, you can get into what's called a self-directed IRA. So you to know, because some people I find really want to do this and they're like, I just don't have the liquidity right now. And they don't know that they can invest in real estate using a retirement account. So that's one of the big things so you want to know, do I have some portion of capital that I could use and I'd be willing to invest in something like this, step one. Then you, like we mentioned, educate yourself, look online, see how to find someone by listening to podcasts and getting on different things and looking on Facebook and social media and asking around through maybe your accountant or maybe you have an attorney friend that does real estate because they have clients they've been working with for a long time, right? Identify who you might want to get involved with and then reach out to them. Reach out and say, hey, I'm potentially interested in investing in real estate and I saw your advertisement, or if you got a warm referral for someone else, or I see that you're connected with my friend Don online or whatever, and then you start the conversation. And it's a conversation. There's no commitment. Don't ever let someone pressure you into doing anything. That's not the type of person you want to do that. You want someone to be able to share the facts with you, let you know the process, and then let you make the decision on what you want to do.
Really, really good advice. So here we are, a sequel. And,
can you believe it? We're already done?
Well, I really think that, you had a great first episode, but I think you really brought the mustard on the second one as well.
Well, I changed, right, Brian? I get, one thing I didn't mention, I, had started my own underwriting class and program over the last year as well. So I underwrite properties. So that's what my expertise in is the real estate world. And I'm known for is my underwriting, evaluating properties and reviewing them for my clients and so forth. So got involved in Vikings. So I'm really happy. It's amazing what can happen in such a short period of time. Different opportunities come up and you can't take every opportunity, but things shift. You got to look and move. But like you said, real estate now is a good time to get involved in. Who knows what's going to happen with the regular economy? There's been a lot of volatility in the stock market, up, down, 1 week, 1 day. So it's hard to do that. So this just gives people, another option. But yeah, I'm glad that we get to reconnect, and I'd love to. I do want to get down there and visit you. It's one of my favorite places. Actually got married in Aruba back in 2003. So eventually, do want to come down there and visit and meet face to face.
Yeah, I see a tax write-off in the future.
Oh yeah, didn't think of that.
I mean, you kind of flew right over it because that's your life and you live and breathe it. But
yeah, sure. Yeah, it's hard sometimes to step back.
Well, thousands of people have gotten where they are using the software you created for underwriting. And, just let that thought sink in for a second. Give yourself a little bit of breath there. And anybody who's watching this, we're fortunate enough to have the Godfather of Underwriting. I'm going to use that in the show.
Thank you.
Right?
Too kind.
Yeah, but
Too kind.
Okay, you could say too kind, but you built the damn thing and people use it. And, I live on an island because of it. So it works.
I do love hearing that. That's my favorite piece, that you can say you lived on an island. If I can leave someone in a better place than when I found them, that's what I love with coaching. I didn't like it at first, Brian. It was hard, because I didn't have a coach before, and I took a lot of people's success on my shoulders. But I also realized over time through coaches I had that, if they're not willing to put in the work, I can't make them successful either. Right. But yeah, that's my, it makes it not work. The reason I think I go over it, because I have a passion for numbers as an engineer, and it's a way to take it into my into real estate, my engineering, and all the time I spent in schooling. And so I just always love numbers. I love finding the problems with deals and what's going on with that. And as you've seen, I'm constantly evolving. I might even have updated the underwriting template since I sent it to you. So I'll send you the new one again with some of the, we're always trying to get better. I mean, that's all we can all wish for or want to do is become the best version of ourselves, keep getting better, do what you love. And people will ask me, well, I didn't invest in real estate for a few years. Well, I was just too busy with everything else going on. I loved what I was doing at the time, and I keep doing something until I don't love doing it anymore. But once you have the knowledge, like you, Brian, and that you can step in anytime you want and do whatever you want. And that's the beauty, is knowledge. You always have your knowledge, and you can jump into and do whatever you want anytime. And from virtually, like you.
Where are you today? Down in Rhode Island?
Yeah, I'm in Rhode Island. Yep.
I'm up in Massachusetts, and here we are, right? I mean,
yeah.
This didn't exist when we started, Don.
I know. Times change. You gotta love it. Technology.
So now you can get on an investor call. You can see someone face to face without having to jump on a plane.
That's also a great thing to mention, to do with someone, see their manner, see what they are. It's like, I could talk to Brian on the phone after not talking to him for because we didn't keep in touch every year. But when we got on a Zoom, it's like you reconnect. There's a different level of connection when you're on a Zoom with someone. So I highly encourage people to do that as well.
So you're still in a coaching program.
Yep.
You're involved with Viking.
Yep.
What other plates are you spinning today for our viewers? Some of them might be interested in reaching out to you coaching, like, again, they'd be getting a drink of water from a fire hose. There might be that investor who wants to Google you, find out all about you.
Sure.
Okay, I like this guy, and invest in Viking. What are some of the ways, the different paths and avenues our viewers could get in touch with you and reach out to you?
Yeah, I'm on LinkedIn, right? So Donald Goff, and it's on LinkedIn. You'll see my face up there. Same thing with Facebook. I'm from Rhode Island, so that helps you with your search and see me on there. Those are two different ways that you can get in touch with me. You can also email me, and you can email me at DG, so those are my initials, DG at next dash level dash capital.com, next dash level dash capital.com. Or my cell phone number is 401 450 5200. Again, 401 450 5200.
Beautiful. And just for the viewers out there, I use what Don does. My lender has been lighting up my phone here saying, you can call me. The closing's
Yeah.
tomorrow, right? How come?
Yeah, don't wait any longer. You want to make sure that goes through.
Yeah, don't worry. But the money's
No, I
in the
know.
bank. But my point is, the deal I'm doing with him tomorrow, I used your underwriting template.
Awesome. I love hearing that.
You know,
Yeah, I like making a difference, Brian. So I love, thank you for always sharing what you've gotten out of the coaching, because that's what keeps me going, right? To see people's success along the way. So
yeah,
thank you.
I mean, just so people know, it helped me look at the numbers, put in all the income, all the expenses. It produced the ROI, the debt income ratio, and that was like the killer on this deal because the rents were so low. I had to offer a low enough price to get the debt income ratio where the lender would go for it. The appraisal came in at like 250 over sale price, so
Nice.
everything worked out. And
Oh, that's so awesome. Love it.
but
Love
on
it.
one dashboard, I'm able to plug in everything and see it. So thanks, Don.
Yeah, you're welcome. I love it.
All right, Don, any last updates for our viewers today?
Yeah, take action. Get out there and take action. Like Brian said, depends what you want to do and what your goals are. But make a plan for yourself and make a difference. If you're looking to change your financial destiny, start making a plan, whatever that is. Whether it's getting involved in doing real estate yourself, or if you want to do hands-off investing. I know a lot of people would love to go start another business, but they don't have the time. So this is another way to do it. With that. And yeah, look me up. But I'd love to chat with anyone that's interested on either side and just from an educational standpoint. And then if it's something you're looking to move forward with in your future, then we can talk about that as well.
Beautiful. Don, you brought the thunder today. I really appreciate you so much. Ladies and gentlemen, all of my real estate peeps, this is Brian Lucier with the Why Not Real Estate Podcast, signing off from another fantastic episode. Thank you, Don Goff, for coming back and being my guest. Ladies and gentlemen, all my real estate peeps, rock stars, and entrepreneurs, we'll see you on the next one.
Thank you, Brian.